JAIIB full crash course is now available in English language also. You can simply go through the videos of our course and that will be just more than sufficient. And other than that, go for the chapter wise previous questions and that will make sure that you are going to clear the exam in the very first attempt. So in this video particularly, we are going to discuss about the accounting and financial management for bankers over there in English language. So do watch this video till end because we are going to cover very important concepts in this particular video. And further, if you have not subscribed to our channel yet, do subscribe to the channel at the earliest and press the bell notification icon so that you get updated whenever we upload the new videos. You can simply click on the link that is available on the screen, or you can actually be visiting the link in the description below and can enroll into the courses over there. So it is regarding the ratio analysis. Before starting with the ratio analysis, let me tell you a few things that we have already learned. So now when we know that in the case of the trading account, the main purpose was to ascertain the gross profit or gross loss. So trading account was somewhat related to the cost of goods. It was related to the cost of goods and we ascertained whether there is a gross profit or gross loss, and with the balance, with the closing balance of the trading account, will be opening what account? We will be basically dealing with the profit and loss account. We will be basically dealing with the profit and loss account, and in the case of the profit and loss account, we are basically dealing with the gross profit, and we are dealing with the operating expenses. What are the operating expenses? What would be the inoperative expenses? What are the other activities from where we are earning the incomes? And we will be ascertaining net profit or net loss from the profit and loss account. Now from the profit and loss account, we basically bring the balance to the profit and loss appropriation account. So if there is net profit, we'll be basically bringing up the balance to the profit and loss appropriation account, where we'll be dividing the balance among the balances among the partners, or in the case of the company, if they have issued dividend, if they have declared the dividend, in that case all the entries would be adjusted over there, and any of the surpluses would go to the balance sheet itself. Now from there the balances will go to the balance sheet itself, and in case if there is net loss, the balance would be added to the asset side. You need to remember this, that if there is net loss, in that case the balances are to be added on the asset side, because net loss is basically an asset for you. I already have told you the reasons why it is so. And further, if it is a profit, it would be added to the capital and surpluses account. It would be added to the capital and surpluses account. Okay, basically surpluses and reserves, that would be added to the net worth actually. Okay, so that is the case regarding it. Okay, so that was all that we have learned till now, and we are going to start with the ratio analysis now. Now what are the ratios? Basically the ratios are of three types. One, it is like 1:2 is one type of the ratio. 1:2 is one type of ratio, and other it could be 1 divided by 2, or it could be 50%. Both three represent what? Both three represents ratios. Now basically in the case of the financial statements, we have got different accounts, we have got different figures in the different accounts. Whether it is a trading account, you have the gross profit, you have the gross loss, and further in the case of the profit and loss account, you have the operative profit, you have the expenses with you, you have got the net profit, net loss, and further in the case of the balance sheet, you have got the asset sides, whether it is a current asset or a non-current asset, fixed asset or intangible assets, and further on the liability side, we have got the capital and surpluses and reserves, and further it is regarding the long-term liabilities, short-term liabilities, all regarding it. So we will be basically getting the different ratios from the different figures itself, and these ratios particularly help us regarding to basically regarding to analyze. We cannot say fondle of, basically we can say these ratios help us to analyze the financial statement in a better way. Okay, so that is regarding it. So we will be learning the theoretical part for now, then further we will be performing some we will be dealing with some practical issues. Okay, now it is regarding the accounting ratios are what? These are the relationships between the different accounting figures. So we have got different accounting figures, as in the case of the profit and loss account, as in the case of the trading account or the balance sheet. So it is basically a relationship between those different figures, and the accounting ratios have been classified as the traditional classification, and further there is a functional classification. So there are two type of classification. One, it is the traditional classification, and other one it is a functional classification. As per the traditional classification, we have got what type of ratios? We have got profit and loss account ratios. Means these ratios would be
these figures would be basically taken from the profit and loss account only. These will not be inter-account statements. These would be only related to profit and loss account. We are taking the net profit, we are taking the some other entity from it, other figure from it. That is basically what related to, that is basically related to only and only the profit and loss account ratio. So whatever figures we are taking only and only from the profit loss account. That is why we say it profit and loss account ratios. Then it is the case of the balance sheet ratios, where we are taking the figures only and only from the balance sheet. So that is basically what, that is the balance sheet ratios. And further, what are composite ratios or interstatement ratios, where we are taking figures from two or more statements, not only from the single statement. We are taking the figures from the different statements. Likewise, we are taking one figure from the balance sheet, we are taking the other figure from the profit and loss account. That is basically what, that is basically the composite ratio. So as per the traditional classification, there are profit and loss ratios, there are balance sheet ratios, and further there are interstatement or composite ratios. Okay, so that is regarding the traditional classification. And when we look at the functional classification, which we would be learning in detail, that is basically there are three types of ratios. You have got the profitability ratios, where we will be learning the different aspects regarding that what is the profitability and how we can improve it. So basically it has got different applications. So if you are going to invest in the company itself, if you are an investor, you will be looking at the profitability aspect. You will be looking at the profitability aspect. So you will be basically having a analysis of the different type of companies. You will be basically analyzing the different type of companies. Basically, you are going to compare those companies, and if you want to compare the different companies, you must know the profitability ratio so as to look into those factors. Then further, it is regarding the turnover or activity ratios. So basically, it is regarding the compound activity of the company which in which it is indulged. So if it is related to some sales, then further it would be regarding the debtor. It may be the debtor turnover ratio, it may be the inventory turnover ratio or stock turnover ratio. So there are different type of turnover ratios which we will be learning. And further, in the case of the financial or solvency ratio, so when the banks are to give the credit, or when the other entities are to extend the credit to the company itself, in that case particularly, it is very much important to know that if the particular company is going to sustain or not. So if there is a company XYZ and further bank is going to extend the credit to the company XYZ, bank would be looking at the fact, bank would be basically considering the fact that whether XYZ would be solvent in future or not. That is very much important from the bank aspect, because bank is going to particularly invest in this particular company over there, and bank wants to know that the XYZ firm itself would be able to pay off its installments or not in the future time. So there are different type of solvency ratios, and further the solvency ratios are divided for particularly into further two categories. One, it is a short-term solvency, and it is a long-term solvency. Now short-term solvency ratios are basically regarded that the company would be able to pay off its liability in coming 12 months or not, or basically related to some short period, that is basically related to what? Short-term solvency. So if we say company XYZ would be able to pay off its liability in the coming 12 months or not, that is basically related to what? That is basically related to short-term solvency. So short-term solvency ratios are those ratios that disclose the financial position. So what is the main purpose from the financial ratios? We have got that we want to analyze the financial statements from these figures. We want to inspect the financial statements from these ratios itself. Okay, so short-term solvency ratios are related to these, and these are also called liquidity ratios. So short-term solvency ratios are also called liquidity ratios. So whenever we are replacing the liquidity ratios word with the short-term solvency ratio, that is basically the same thing. Okay, and further long-term solvency. Now where the long-term solvency is related to, further if I tell you that in the case of the short-term solvency ratio, when a CC limit is extended or a working capital is extended to a company, in that case bank would be basically looking into the short-term solvency ratios. But in the case of the long-term solvency ratios, likewise, a machine term loan has been extended to the company for the next 10 years. In that particular case, bank wants to look into the fact that the company would be able to sustain or would be able to pay off its installment for the next 10 years or not. So bank would be looking into that long-term solvency ratios in that case. Okay, so if a term loan of more than 1 year is extended to the company, in that case bank would be looking into the long-term solvency ratios. So these particular ratios are DSCR, that is debt service coverage ratio, and further other different ratios are over there. And in the case of the short-term solvency ratios, what are the different ratios? There is a current ratio, there is a quick test, there is a quick ratio or acid test ratio, and further there is a DER, that is debt equity ratio. So we'll be learning regarding these different type of ratios. You need to understand that what is the purpose of calculating some particular ratio and how it is going to be important, and further what is the trend, that if it is increasing, that is basically good or not, or if it is decreasing, that is good or not. Okay, so we'll be learning regarding all those. So what are the uses of accounting ratios? First of all, these are some basically related to some theoretical questions. So many of the theoretical questions may be asked from it, because in the case of accounting and finance for banking also, many of the candidates have the misconception regarding that there is very much numerical numerical are there in the case of the accounting and finance for banking, but that is not so. You also have to learn the basics if you want to clear the exam. Okay, so what are the uses of accounting ratios? First of all, it is regarding simplify financial statements. Now if you are a layman and if you look at the financial statement itself, you will not be knowing the different facts now, so it will not be able to understand it. You will not be able to understand it. So if you want to simplify the financial statements, if you look at some particular figure and if you know the trend, that if it is increasing it is good, if it is decreasing it is bad, you can simplify basically financial statements. You can learn them quickly, and further it facilitate inter-firm comparison. Inter-firm comparison means if I want to compare different two firms, firms, that would be basically inter-firm comparison. I can compare two basically different firms. Okay, and further it helps to facilitate intra-firm comparison. Now what is intra-firm comparison? It could be a case that there is a group of companies. A same group is having XYZ company, same group is having ABC company, and if I want to compare those both, I can do so with the help of the accounting ratios. Further, it helps in planning. Basically ratios helps in planning. So if I am having some particular ratio, let us say current ratio is equal to 1.31, and if I aim at that, I want to increase that particular ratio to 1.75 or 1.70, that would be basically helping me to plan, and further I can also forecast regarding it. So there are different techniques by virtue of which we can forecast the different ratios, that what would be our future trends or not. Okay, then there are some limitations also, and you must consider those. Now first of all, ratios provide a glimpse of the past performance. Now if you look at the different statements, if you not have the projection balance sheet with you, in that case basically we are taking the figures from the past year data. Because the balance sheet is prepared at the end of the accounting period. You have prepared the balance sheet for the last year, and you're taking the figures from that particular balance sheet or the profit and loss account, and further you are having the ratios with you. So you are basically getting the ratios from the past performance, and further it could be the case that you want to forecast it, but ratios just give you an idea regarding it, that what was the trend and what would be the forecast regarding it, because it is not a clear picture, because several other factors are also there. Likewise, market condition, it could be the management policies which also affect the future operations. That is why ratios just give you an idea regarding it. You cannot completely rely on it. Okay, further it is regarding the limitation of the financial statement. Now what is the limitation of the financial statement? Financial statement are basically prepared by the company itself. These are prepared by the company itself. So if there is some kind of issue with the financial statement itself, and further the ratios are also generated from it, then the ratios would also be not reliable. Are you getting the point? Because the information which has been recorded in the financial statements, these ratios are basically based on that particular information only. So if it is basically leveraged, or if it is basically manipulated, in that case those would not be reliable. And further it is regarding ratios alone are not adequate. These are not adequate. Let me tell you one thing. Let me give an example regarding it. So current ratio, which is a liquidity ratio or short-term solvency ratio, current ratio is basically equal to current assets divided by current liabilities. This is basically equal to current assets divided by current liabilities. And further it is always better that you have current ratio, it is having a positive trend. What do you mean by positive trend? So if one firm is having 1.15 of the current ratio and the other company is having 1.50 of the current ratio, the 1.50 current ratio would be considered better. It would be considered better because in that case particularly we can say that more of the current assets are available. More of the current assets are available with the company, and the company can meet the short-term liabilities. You can understand it better way that if you have rupee 100 in your hand, and if you are to spend rupees 50, it is easier for you to spend. But what if you have rupees 100 with you and you have to spend rupees 90, or it may be the case that you have rupees 100 with you and you have to spend rupees 110? In that case, you must have to borrow from the market itself. That is the case in the company itself also. So better the CR, better the current ratio, better it is. But there are different components of the current assets. Like one component, it is related to the stocks or inventory that you are maintaining. But in the case, likewise, let us say the company XYZ is having current ratio is equal to 2. So it is having better current ratio, and company ABC is having current ratio is equal to 1.75. Now you will say that the current ratio 2 is better and company XYZ is performing better. But there are some different factors also. Likewise, I told you that in the case of the current assets, you have one figure that is related to the stocks, that is related to the inventory. It could be the case that XYZ firm itself is maintaining dead stock. It is maintaining dead stock. Dead stock means that stock which you are not able to sell. So if it is outdated stock, if it is dead stock, and further you are considering these stocks as your current asset, in that case you are basically leveraging that figure. You are manipulating that figure, and that would not be appropriate. It could be the case that ABC would be performing better, but ratios shows you some different picture. Okay, so that is also a limitation. So alone ratios are not adequate. You must have complete knowledge regarding it. You must be looking into the different factors which could affect it so that someone could not manipulate it. Then it is regarding the window dressing. Window dressing is also kind of some manipulation. It is also some kind of manipulation. You must be aware of the term window dressing. In past, banks were also doing this. Likewise, in the end of the accounting year. What was the process? That you will be disbursing the amount from the loan accounts. And further you will be keeping those balances in your saving fund accounts or current accounts. You will be keeping those balances in your saving fund accounts or current accounts. So what would be it? That on 29th of March you were having your loan amount loan outstanding equal to 10 crore, but on 31st March your books are showing 12 crore of the advances. This is basically what? This is basically the window dressing. Now when you will be looking at the balance sheet of the bank, so in that case particularly you will be having different ratios. But that is not the actual position of the bank. The actual position of the bank, and that may also happen in the case of the companies itself. So it is also one of the limitations. And further, it is regarding the problems of price change levels. So financial analysis is based on accounting ratios. Will give basically the misleading results if effect of changes in the price level are not taken into account. If the effect of price changes are not taken into account. Likewise, if you were maintaining a stock of rupees 10 lakh, but right now the lower value of the stock in the market is only 5 lakh, but you are still considering 10 lakh of the value. In that case particularly, the ratios will not be giving you a clear picture regarding the financial statements. Okay, so that is basically also the problem related to limitation related to it. And further, it is that there are no fixed standards for the ratio. So there are no ideal ratios which are available. These vary from company to company, these vary from market to market, these vary from type of industry to industry. Okay, so these are some of the limitations. Let me remind you what were those. So first, the limitation that it is only a glimpse of the past performance or just a forecast for the future, it is not a reality. And further, there is limitation of financial statements because you are going to have the ratios from the financial statement itself. So if financial statements are manipulated, there will be issues with the financial ratios also. And also the ratios alone are not adequate. You must be looking into the different factors when you're going to consider those. And further, it is regarding the window dressing that I already told you, that the balance sheet or the profit and loss account can be manipulated and you must be aware of it. And further, the problems of price level change, and then the no fixed standards of the ideal ratios. Okay, then it is regarding the calculation and interpretation of various ratios. So first of all, we will be learning regarding the solvency ratio. So there are two categories of solvency ratio. One, it is regarding the short-term solvency, and other it is regarding the long-term solvency. So when we are considering regarding the short-term solvency, basically we are going to deal with those ratios which will let us know that the company is going to sustain in the near future or not, that the company is going to sustain in near future or not. So company is considered to be solvent or financially sound if it is in a position to carry its business smoothly and meets its obligation. So what is the main thing that we require, that a company would be sustainable, that a company would be solvent in near future? If it is able to pay its obligation, So what are the different obligations? It could be the case that there are sundry creditors from whom you have taken the loan. These could be the sundry creditors. It could be the case that you are to pay the rent. It could be the case you are to pay the wages. It could be the case that you are to pay the electricity bill, or it could also be the case that you are to pay the bank installment. So there are different types of liabilities. There are different type of obligations which are to be met in the near future. Okay, so if you have got the assets related to those from where you can pay those liabilities, in that case we will consider it that the company is a solvent in the near future. Otherwise we will say it is not. So as I told you that there are two type of solvency ratio. One it is the short term solvency, and other it is the long term solvency ratio. And short term solvency ratio is also known as the liquidity ratios. So in liquidity ratios, first of all, we will be learning regarding the current ratio. Now current ratio is very much easier to understand. It is the current assets. It is a ratio of the current assets with the current liabilities. Now we are already aware with the different entities of the balance sheet. If you remember, on the left hand side we were having the liability, because the liability is having what balance? On the left hand side we are having the liability, and on the right hand side we are having the assets. So liabilities are in credit balance and the assets are in debit balance. First of all, let me remind you the basics regarding it. And further, in the case of the liability, you were having the capital and reserves. And further you are having the long-term liabilities and short-term liabilities. And these short-term liabilities were basically nothing else, but these basically were related to the current liabilities. These were basically the current liabilities, means those liabilities which are to be paid off in the next 12 months. That is basically what? That is basically the short-term liability. And if we want to, if we know the different entities of the assets, what were those? One of it was, first of all, it was regarding the fixed assets. Then there were the non-current assets, and then there were the short-term uses or short-term assets, which were the current assets. So what were the different current assets? You were having the cash balance, you were having the bank balance. These were the prepaid expenses. Those also basically relate to the current assets. If you are having the tradable or quoted securities, those are also current assets. Stock is also current assets. So those were basically the different components of the current assets. And also in the asset side, you were having the intangible assets. Intangible assets like patent, goodwill, or you were having the preliminary expenses. Okay, so all those were related to the assets. All these are entities of the assets. In this particular ratio, you need to just figure it out, what are the current assets and what are the current liabilities, and that will give you the current ratio. So I already told you that current assets divided by current liabilities, and how you need to understand this particular ratio, that what is the trend. So higher current ratio is what? It is desirable. But if one of the firm is having very high current ratio, it is not desirable. Why it is not desirable? It means that the management of the current assets is not well. that the management of the current assets is not well, because you have a lot of money in your hand but you are not able to manage it. You are not able to manage it. So basically the current asset is related to those assets that will change their form, from one form to another in the next 12 months. Okay, so either one asset would be converted to one another asset, or it could be the case that the assets would be used to pay off the current liabilities or the long-term liabilities. Okay, that is the case regarding it. So that is basically current asset. Basically, if we look at the only this particular factor, that is a current asset, this is what? This is your gross working capital. This is basically your gross working capital. Gross working capital means that capital which you are going to use, to pay off your short-term liabilities and long-term liabilities. Okay, so that is the case. Then it is a current liabilities. Current liabilities are those liabilities which are to be paid off in the next 12 months. So current assets divided by current liabilities. If you have more money in your hand but the liabilities is less, in that case that particular ratio would be greater than 1. If current assets is equal to current liabilities, then it will be equal to 1. And further, if you have current assets lesser than that of current liabilities, in that case current ratio would be lesser than 1, and this condition is not desirable. This condition is not desirable. Even if you have current assets is equal to current ratio, what would that mean? What would that mean? That will mean that you need to borrow in the near future from the market itself. If you have 100 rupees and 100 is your expense, you will be left with rupee 0. What if there is some contingent expenses? What if there is some future expense which you never knew? In that case, it is not desirable. And further, if you have expenses of rupees 110 and you have rupees 100 with you, in that case, you need to borrow from the market for the short term. You need to borrow from the market from the short term. Okay, so that are the different scenarios, and that is how we calculate it. And further, what is the ideal ratio for the current ratio? It is 2. It is 2. So what is the benchmark ratio for current ratio? It is 2. Okay, a very high current ratio is not desirable, as I already told you. It may be asked in the exam itself. It could be asked like that XYZ firm is having the current ratio is equal to 1.75 and ABC firm is having current ratio is equal to 3. Which one is better? Definitely we can say the 3 is better, but if there is some particular option where it is written that 3 is better, but it also shows that the company is not able to manage its current assets. Okay, it could also be the case. So you must know the basics regarding it. Okay, so that was regarding the current ratio. After that, it is the liquidity ratio, or we simply say it SC test ratio or quick ratio. So basically it is some stringent, it is the stringent form of the current ratio. It is the stringent form of the current ratio. In the case of the current ratio, we learned that current ratio is equal to current assets divided by the current liabilities. Current assets divided by the current liabilities. But in the case of the asset test ratio, quick ratio, or simply the liquidity ratio, we are saying quick ratio, that is basically equal to quick assets divided by current liabilities. Now the denominator is the same. Now the denominator is the current ratio. Why it is stringent? Because in case of the current assets, we are considering all the assets, all the current assets. We are considering all the current assets. Likewise, we are considering the stocks. We are considering the stocks or inventory. We are considering the prepaid expenses also. Prepaid expenses are also what type of assets? These are also the current assets. Okay, so these are also your current assets. But if you look at into the depth of these assets, particularly it is not possible that you can sell the stocks very shortly. So it is always considered that it will take time to sell the stocks. It will take time to sell the stocks. So your stocks are not considered as your quick asset. This is not considered as your quick asset. So what is the definition of quick asset? Those assets which are readily convertible to the liquidity, which are readily can be liquidized, those are basically your quick assets, and stock is not your quick asset. And further, in the case of the prepaid expense, this money is not available with you. It is shown on the current asset side because this is a advance expense that you have already paid, but it is not the amount with you itself. If you have paid the rent in advance, it would be basically prepaid expense. It would be basically related to your prepaid expense, but that money is not available with you now. You cannot pay off other liabilities with it. You cannot pay off other liabilities with it because you have already paid this amount to someone. You have already paid this amount to someone, you cannot pay off your liability with this. So that is also not to be considered. That is also not to be considered. Okay, so what is the definition of the quick assets? Those assets which can be readily convertible, into the liquidity or can be converted into the cash itself. Okay, so that is the definition of the quick assets. So the ratio says quick assets divided by the current liability, and ideal ratio for liquidity ratio or quick ratio or acid test ratio is 1. For the current ratio, the ideal ratio is 2, but for the quick ratio, the ideal ratio is 1. Okay, and this ratio is an indicator of the short-term solvency of the firm. So both the ratios are indicator of the short-term solvency of the firm itself. Just quick ratio is a stringent form of the current ratio. Okay. Then it is regarding the long-term solvency ratios. What is a long-term solvency ratio? If you have taken an advance from the bank itself, if you are going to sustain in the near future or not, but also for a longer period than 12 months, then it is basically related to what? It is basically related to long-term solvency of the firm. It is basically related to the long-term solvency of the firm, and that these are also called leverage ratios or solvency ratios. These are also termed as leverage ratios or solvency ratios. And further, the first ratio that we are going to learn about is the fixed assets ratio. It is basically the fixed assets ratio. Now, what is a fixed asset? You already know what are the fixed assets, which are basically the land, building, machinery, or which are basically your fixed. You are not going to sell them. Those are not available for sale. Those are not available for sale. You are not going to sell and purchase. You are not going to trade those particular assets. Those are available for you for longer period. Okay, so that is basically fixed assets. And fixed assets divided by long-term funds is the definition of the fixed assets ratio. So how you can calculate this ratio? Fixed assets divided by the long-term funds. Now, what are the long-term funds you have available? What are the long-term funds you have available? All the long-term funds include three things particularly. Basically, it is a capital which is infused by the promoters or investors, and further the long-term fund which is available with you is a reserves that you are having, and further you are having the outside long-term liabilities. Outside long-term liabilities, these may be related to the loans that you have taken from the bank itself. So it is outside long-term liabilities. So these are the three components of it. Okay, now there is one important point regarding it that you need to understand. So now we know that the ratio is equal to fixed assets divided by the long-term funds or long-term funds. That is the definition of it. Now try to understand that particular point, that all three terms were in total equal to 30. The total of all three terms, let us say it was equal to 30, and the fixed assets are 25. Okay, that is basically considerable. That is considerable because it says that out of 30 rupees that was available for you to you for long term, you have spent 25 on the fixed assets. What if fixed assets are equal to 35 and you have long-term funds of 30? What does it mean? It means that you have consumed your short-term liabilities, because we know that liabilities are what? Liabilities are sources out of which you create the assets. Now, if you have the liabilities, if you have surplus of the fixed assets, then the long-term funds, what does it indicate? It indicates that you have consumed your short-term uses. You have consumed your short-term assets you have consumed your short-term liabilities so as to get more fixed assets. That is some of the part of the working capital, or it could be the case of the current liabilities have been utilized so as to get the fixed assets. Okay, so that is what it indicates. Are you getting my point or not? Kindly please confirm if you are clear with this point or not, because this is important point and you must know it. Let me explain it to you once again, that you are having the fixed assets, like different fixed assets with you. You are having car, you are having the building, you are having the machinery, and particularly car is worth 10, building is 20, and machinery is worth 5. In total, the total is 35. the fixed assets total is 35, and further on the liability side, we are considering the liability side over here. Let us say capital plus reserves amount is 20, and further your long-term liabilities, let us say the debts or securities that you have issued, or it may be the case that a bank loan that you have taken, those amounts are basically equal to 7. And further, in the case of the current liabilities or short-term liabilities, you are having the let us say it is 9, and further in the current liabilities you are having 30 with you. You are having 30 of the current liabilities available with you. Now out of 35 of the fixed assets, you basically consumed this 29 of the capital plus reserves and long-term liabilities. Okay, so that would be basically 29 you have got from the long-term funds. These basically indicate what? These basically indicate the long-term funds available with the firm. Okay, so you consume 29 of the long-term funds as to convert them into fixed assets. So basically you procured fixed assets, 29 of the funds came from the long-term funds, and rest of the 6 of the funds, if we subtract 29 from the 35, it is 6. So 6 of the funds came from the current liabilities. So in a way you can say you basically consumed the current liabilities so as to create your fixed assets, which is not done. Okay, so that is the case regarding the fixed asset ratio. Then it is regarding the DER. Basically we are learning regarding the long-term solvency ratio, and the second ratio it is regarding the DER. Now what is DER? It is debt equity ratio. It is basically related to the financial leverage. Now what is financial leverage? Now let us understand this with an example. So person A over here started a business. Company XYZ over there, and further he infused rupee 5 as his capital. And further took bank loan. Further has the shareholder equity, and further has the other creditors. Other long-term creditors, and in case he basically borrowed 35 rupees in total. And person B over here started the business, but he infused 25 as his capital, and he started business with from ABC, and further his long-term liabilities are only 10. Now if we look at the total of the assets, that will be basically equal to let us say it is 10, and that is basically, let us make it 15. Okay, so you have the total of the assets equal to 40. In this case you have the total of the assets in 40 in that case also. Okay, because we know that total of assets is equal to the total of liabilities. So you have the 40 in both the cases, but which one would be the better one? A is better or B is better? Which one is the better one? Kindly please answer the following at the earliest so that we could proceed with the example. So person A infused capital amounting 5, whereas the person B infused capital of 25, and further person A borrowed 35 of the funds from the market for the long term, and B borrowed 15 of the funds from the market itself for the long term. Which one is better? Both of them have the same assets and liabilities, 40-40. Which one is better? Definitely B is better. Why B is better? Because there is financial leverage. Lesser than that of the person A. See, one thing is there. Financial leverage is required. First of all, you need to understand what is financial leverage. Financial leverage means that what funds we were having and what funds we have taken from the market itself so as to grow our business. Okay, now if you have very much higher financial leverage, that makes the business very much riskier. It may give you very high profits, but it may also lend you to give away your money. So leverage is required, but very much higher leverage is also very much riskier. Okay, you must know that point. Okay, so DER is calculated to ascertain the soundness of the long-term financial policies of the firm. If you have if you have higher financial leverage if you have very high financial leverage, in that case that is a riskier proposition and that is not required. So if DER is lesser, that is basically you can say the company is secured. The company is secured somewhat. Okay. So now what is the definition of it? It says the ratio can be calculated as external equities divided by internal equities, and the formula that we'll be using in the numerical itself, it is basically the long-term outside liabilities divided by tangible net worth. Long-term outside liabilities you are talking about. Long-term outside liabilities. Now what are the outside liabilities? What are the outside liabilities? We are not talking about the capital and reserves. We are only considering what part? We are only considering the long-term liabilities. Likewise, you have taken a term loan from the bank, or it may be the case that there are that the securities or debentures that you have issued. Okay, so that is basically a long-term outside liabilities. And what is tangible net worth? Now first of all, what is net worth? It is basically promoters contribution. Basically we are talking about the capital and reserves. We are basically talking about the capital and reserves. Okay, so that is what? That is your tangible net worth. That is your tangible net worth that were available, that were infused by the owner itself. That is basically your net worth. Not tangible net worth, that is basically your net worth. So net worth is what? Capital plus reserves is your net worth. Capital plus reserves is your net worth. And what is tangible net worth? When you will be subtracting intangible assets from it. When you will be subtracting intangible assets from it. Now you know what are the intangible assets, different assets. First of all, it is the preliminary expenses that were spent when the company was set up, but these are not available now. You are going to consume these assets for the longer period, but these are not available. So these are the preliminary assets. Intangible assets are preliminary assets, or it could be the case of the goodwill, or it could be the case of the goodwill or patents. All these are basically what? All these are your intangible assets. Those are to be subtracted from the net worth. That will give you tangible net worth. That is our denominator part. Okay, so in the case of the long-term outside liabilities, you already know that what are the different components of it, and further divided by the tangible net worth. That is the net worth minus the intangible assets. Net worth minus the intangible assets. Okay, so that is what? That is your DER. That is your DER. Now what should be the trend? Increase is better or decrease is better? What is better? Now if we say XYZ firm has got DER, we are comparing basically DER of two companies. One is having the DER is equal to 1.45, whereas the ABC firm has got the DER equal to 1.10. Which one is better? Which one is better? Which one is better? See, higher the outside liabilities will lead to you insolvency. If you have higher of the outside liabilities, that would basically lead to you insolvency. So lesser is better. Lesser is better. You are to look into what? You are to look into the formula of it. You are to look into the formula of it. You just need to remember this thing. You just need to remember this particular part, that long-term outside liabilities divided by tangible net worth. Now if tangible net worth is more, that means that the owner contribution is more. That means owner contribution is more. He is not in tension regarding what amount is to be paid to the outsiders. He is not basically having the tensions regarding the outside liabilities now. So financial leverage is basically lesser. So lesser the financial leverage, more secured the company is. More secured the company is. Okay. Financial leverage is definitely required. Financial leverage is definitely required. But if you have very much higher financial leverage, that is not basically desirable. Okay. Then it says the debt service coverage ratio. Now what is the service coverage? What is the service? Why do you say it is service? If you will be able to pay off your installments or not? If you will be able to pay your installments or not in near future. Okay, so that is basically related to servicing the installments. That is basically related to services the installments or servicing the debt. So that is what debt service coverage ratio tells us. That is what debt service coverage ratio tells us. If I am having rupee 10 in my hand and I am having installments of rupee 5, what would be it? It would be basically equal to 2. What if I am having rupee 10 in my hand but installments are rupee 9 which are to be paid? Which are to be paid? Is it desirable? No, it is not desirable, because I am not having current assets in my hand. I am not having gross working capital in my hand so as to deal with the so as to operate my business. So that is not desirable. So lesser the DSCR, it is lesser desirable, and it should not be lesser than 1. If it is lesser than 1, it means you have to take outside, borrowing. Okay, so there must be borrowing in that case. I'll be letting you know each and everything, that what are the different components of the formula and how we are going to calculate it, and further how you can remember it easily. Okay, now as I told you that the installments regarding the thing, so let us consider that firm XYZ is over here and it has taken a loan amounting rupees 10 lakh from the bank, and further the monthly installment is, let us say, rupees 10,000. Monthly installment is rupees 10,000, and further its profit after tax is rupees 2,40,000. Its profit after tax. Now we know the different terms regarding the PAT. Now what is PAT and where we read it about it? We read it about under the profit and loss account. So PAT is given to be 2,40,000. Let us consider it that PAT is given to be 2,40,000, and further in that case, what would be the yearly installment amount? That would be multiplied by 12, and that would be 1,20,000 of the amount that is to be paid in the form of the installments. Now let us consider, in the case of the profit after tax, when you are considering, you have not basically subtracted the interest from it. Now whenever you are ascertaining the net profit from the profit and loss account, you are subtracting two different things from it so as to ascertain it. One, it is regarding the interest that you subtract from it. Interest on the term loan that you are paying. Now if I have taken loan of rupees 10 lakh, I am also subtracting the interest component of the loan. from the expenses itself, on the expense side itself, so as to ascertain the net profit. Okay, so that component is basically also my income, because I'm considering it in the if I say I'm to calculate DSCR, simply it would be basically my profit. Divided my installment. In basic layman term, that is the formula. Now if we see the installment we are paying, if we look at the installments we are paying, we are basically paying the interest part also. But when we calculated the profit over here, the profit after tax, we also subtracted the interest from there also. While calculating the profit after tax, we also subtracted the interest component from it. After that, we subtracted the tax. Now that is why we need to add it again. Because we cannot also subtract it and cannot also subtract it from the numerator part. It is to be considered in one component only. It is to be considered equally in both the sides, on both the components, that is on the numerator component and on the denominator component. That is why we will be adding back the interest component of the loan. So that is also my profit, because that is to be equated. Okay, so now that these are equated, now you must be learning, if you have we have already gone through the concept that depreciation is what? Depreciation is a non-cash expense. Depreciation is what? It is a non-cash expense. It is charged on our fixed assets. It is basically charged on our fixed assets, but in case of the depreciation, no cash goes out. It is just an expense that we book into our books so as to show a clear picture of the accounting. Because we are using the fixed assets for a longer period, and we want to show a clear picture that we are using the particular fixed asset for 5 years. So we have divided the value of it accordingly. Okay, so that is why we are showing it on the expense side in the profit and loss account, but it is a non-cash expense. That is why it is also to be added up. If I'm saying I'm having 2,40,000 of the income, that is a profit after tax that we considered over here, and further that depreciation was amounting rupees 20,000, that is also available with me now, because I have not paid rupees 20,000 to anyone. That amount is particularly also available with me. This particular depreciation amount is also available with me. I can also pay my installments from this particular amount. So this component is also to be added up to the numerator, because that is also my income that is available with me. So in the numerator part, we are considering the income component, and in the denominator part, basically we are considering the installment components. Okay, so that is regarding the formula. Now look at the formula. What it says? It says profit after tax. profit after tax plus the depreciation plus the interest amount on the term loan. So there are three terms. One, it is a profit after tax plus the depreciation plus the interest component on the term loan divided by the annual interest on the term loans and on the long term loans and the liabilities and annual installment. So it is basically the installment, the total installment, principal plus interest installment. So that is it. So that is the formula of debt service coverage ratio. So more the income you are having, it will increase. So or lesser the installments you are having, it will be more. Okay, so that is the thing regarding it. And more the DSCR, better it is. So if one of the firm is having DSCR equal to 2 and the other firm, let us say ABC, is having DSCR equal to 2.5, which one is better? 2.5 is better. 2.5 is better. Okay, so it means they are having 2.5 times of the income available with them so as to pay their obligations. Okay, that is what the DSCR signifies. And what is the benchmark ratio for the DSCR? It is 2. What is the benchmark ratio for DSCR? It is 2. Okay, in the other than the PAT, it may be said that you are available with the PBIT. You are provided with the PBIT. Now what is PBIT? PBIT is profit before interest and tax. In that case, it is profit before interest and tax. In that case particularly, you need not to add the interest component. Okay, so that is regarding it. So when we will be basically going through the numerical in the next session, you will be learning regarding that how to use these particular terms. Okay, further it is regarding the turnover ratios. So there are different turnover ratios. First it is regarding the stock turnover ratio. Now what does stock turnover ratio signifies? First of all, have a look at the formula over here. Now it is given cost of goods sold during the year. Divided by average inventory. Now what is average inventory? Average inventory is basically the opening stock and closing stock plus closing stock divided by 2. That is basically your average inventory. And what is cost of goods sold? If you remember the formula that we have already covered, basically it is from trading account. It is basically from which account? It is basically from trading account. So you must be learning the different components of the trading account and profit and loss account and the balance sheet so as to remember these particularly, and you can definitely solve the numerical from it if you are having the basics with you. Okay, so what is the cost of goods sold, which we basically say it is a COGS. What is the cost of goods sold? If you remember, kindly please let me know. So I'm giving a time to you regarding the 20 seconds. Kindly please let me know what is the cost of goods sold formula. Anyone, kindly please do post. Okay, let me tell you then. So it is basically whatever the purchases you have made, and whatever amount you have spent on it, likewise you must have spent direct expense. You must have the direct expenses or any of the labor cost, whatever the amount you have spent, that would be basically added to it, and you will be subtracting the closing stock. From it. That is basically cost of goods sold. Okay, so that is the formula regarding it. So it may be the case that you are given with the different components so as to calculate the cost of goods sold, and further it could also be the case that you are not provided with the cost of goods sold and simply sales is given to you. In that case, how you can calculate it? You can simply calculate by sales divided by average inventory. Now if sale is given, average inventory is given, you can calculate the stock turnover ratio. stock turnover ratio. Now what does simply this stock turnover ratio signifies and what would be the trend regarding it? So first of all, let me tell you what is the significance of it. What is the significance of it? Now if you have made sales of 300, if you have made the sales of 300 and let us say the average inventory that you have, that is equal to 20, that is equal to 20. In that case, what does it signify? So what is your stock turnover ratio in that case? It would be equal to 15. It would be basically equal to 15. Let us say it is in the case of the ABC firm. Now consider the case of the XYZ firm, in which case we are having the sales equal to 100 and further the average stock was equal to 20. In that case equal to 5. In that case it is equal to 5. So particularly if we compare these two, in the first case, in the case of the firm ABC, basically the firm ABC was able to replace its stocks in full 15 times. So 15 times its stock was replaced. 15 times its stock was replaced. But in the case of the firm XYZ, only 5 times its stock was replaced. Now which one is better? Which one is better? Firm ABC is better one. Firm ABC is better one because in case the firm is able to replace their stock 15 times. Okay, so higher the stock turnover ratio, higher it is. Higher the stock turnover ratio, better it is. Higher the stock turnover ratio, better it is. Okay. Then it is regarding the debtor turnover ratio. Now we know the debtors are very important, and in the case of the banking and in the case of the companies itself, when you are basically doing the business, particularly you have to give credit. You have to give credit in the case that you are having the trade debtors. It could be the case that you are having the trade debtors, and further it could be the case that you have drawn the bill of exchange and further those are accepted. And further those are accepted, and in that case that would be those would be your bills receivables. Those would be your bills receivables. So these are basically all your debtors. These all are your debtors. These all are your debtors. So stock turnover, so debtor turnover ratio is basically equal to what? Debtor turnover ratio is basically equal to credit sales divided by average account receivables. Debtor turnover ratio is basically equal to credit sales divided by average account receivables. But if you are not given with the credit sales in your question, in your numerical, then you will be considering sales only. Then you will be considering sales only. Okay. Kindly please hold for a second. Okay, so that is the basically case. In the case of the debtor turnover ratio, you are having the credit sales divided by the average account receivables. Average account receivables, and these account receivables include both. Account receivables basically include both the terms trade debtors and bills receivables. If you are not provided with the opening account receivables and closing account receivables, you will be simply considering account receivables as the denominator part. Okay, are you getting the point? Okay, so that is the case, and how you can calculate it. Now debtor turnover ratio basically signifies what? Debtor turnover ratio basically signifies what? It basically indicates the efficiency of the staff so as to manage the debts. That how efficiently you are able to get back or recover your debts. You are able to recover your debts. Now if you have basically the credit sales greater than is equal to 100, if you have basically your credit sales equal to 100 and your account receivables is equal to 50 in case of firm ABC, and in case of firm XYZ you are having your credit sales equal to 100 and have account receivables equal to 20, you have ABC firm is having the debtor turnover ratio is equal to 2, whereas in case of XYZ firm the debtor turnover ratio is equal to 5. Now which one is better? Which one is better? So the credit sales were same. But in case of firm ABC, you are having more debtors turnover ratio. Why it is so? The denominator part is larger one. The denominator part is a larger one, and further your receivables are more. Your receivables are more. But in case of XYZ firm, your receivables are lesser. Your receivables are lesser. Okay, so which one is better? Which one is better? XYZ is better one. XYZ is better one because your receivables are lesser in this case. You have already recovered more of the receivables. You have already recovered more of the receivables. That is higher the debtors turnover ratio, better it is. In the case of the firm ABC, still there are 50 of the account receivables which are to be recovered, but in the case of the XYZ firm, only 20 of the account receivables are to be recovered. So higher the debtors turnover ratio, better it is. Higher the debtor turnover ratio, better it is. Okay, are you getting my point? Next, the point, it is regarding the debt collection period. It is regarding the debt collection period. Now, what is basically the debt collection period signifies? It says the average time period so as to recover the debt or account receivables. It is the average time so as to recover the account receivables. That is your debt collection period. It is in days or months or years or whatever the or whatever term you want to calculate, So if we say we want to calculate it for in months particularly, in that case it would be basically your average account receivables multiplied by 12 if we want to calculate in months. If we want to calculate in days, then we will be multiplying it with 365, and further if you want to calculate in weeks, then you will be multiplying it with 52. Okay, and divided by the credit sales of the year. Now in the case of the firm ABC, you are having the credit sales equal to 100. In case of XYZ, you are having the credit sales equal to 100 again. But in ABC, you are having the average account receivables equal to 50. So receivables are equal to 50 in case of ABC, but in case of XYZ, the receivables are equal to 20. So what would be the debt collection period? It would be equal to 50 into 12. If I want to calculate in months, it will be 50 into 12 divided by the credit sales for the year. So it is 100 given over here. So in the case of ABC, it would be equal to 6. And further, in case of XYZ, it would be equal to 20 divided by 100 into 12. So it will be equal to 12 by 5, that is equal to 2.4. That is 2.4 in this particular case. Okay. So in this particular case, if you look at, you are able to recover your debts averagely in 2.4 months. You are able to recover your debts, you are able to recover your account receivables averagely in 2.4 months. Whereas in the case of firm ABC, you are able to recover your debts, you are able to recover your account receivables averagely in 6 months. Which one is better? If you are doing recovery in a better way, that is more efficient. So XYZ is more efficient. Okay. That was basically the debt collection period. So shorter the debt collection period, better it is. Debt collection period, better it is. Okay. Then it is regarding the profitability ratios.
So that will be all related to this particular video. Thank you so much and see you again on the other side. Don't forget to enroll into the courses and start preparing for your exam for sure success in JAIIB 2023.